Neelkanth, fantastic to have you back and thank you for joining us. My introduction, I guess, was the first question. If you look at large cap stocks, there is no bear market. If you look at mid and small cap stocks, there is a gut wrenching bull market. Why are markets so polarized?
Well, the first thing is that the BSE 100, actually Nifty 50 and also BSE 100, there is a very large proportion of revenue that comes from outside India, and that revenue is actually being boosted by, or rather the expectations of those are being boosted by the weaker rupee. And so you will find that some of those sectors are actually seeing earnings upgrades in rupee terms, and that I think is a big supporting factor. There is also, and this is something that you also alluded to in your initial remarks, which is that there is an element of risk aversion. So Credit Suisse has a risk appetite index, which at a global level is in very negative territory right now. If you look at only equity risk appetite, it is at the lowest level since 2011. So there is tremendous uncertainty, be it around China, be it around the impact of trade wars, be it the first half slowdown and that happened in the world, in Japan, in Europe, and whether second half we will see a recovery. And given all of those uncertainties, in addition to say the political uncertainty in India, because the elections are approaching and the markets are naturally jittery, people are starting to move towards much safer stocks. And what we observed was that the performance this year, so while the fact that Nifty and Sensex have done much better than the small and mid cap indices is well known, even within the Nifty, the performance is really concentrated. So the top 10 stocks by contribution have contributed to 218% of the Nifty's gains. This is the most concentrated, is the second most concentrated in the last 12 years. The most concentrated was 2015. So it is a very polarized performance. It is partly because of the rupee impact and mostly because of risk aversion among investors.
So what happens next? Since you've mentioned that historically this kind of a polarized market has rarely happened, what should we expect now? Will the polarized nature change, or will mega cap stocks come down?
Well, I don't think this type of reversal actually happens with the big cap stocks coming down. It generally happens because the other stocks starts to do well. But yeah, that potential exists. A risk appetite reversal can actually mean that some of the high PE and safer stocks start to come down in absolute terms. Though I personally think that as comfort emerges on global growth, that we see the market realizing that while there is quite a bit of concern around the potential future impact of trade wars, that the current economic momentum, and European data, for example, the PMIs have been quite strong or have been picking up. The credit conditions are still easing, and the Chinese government is now suggesting there would be a stimulus. There's a stimulus on the way. So as that comfort comes through, I think the more beaten down sectors, even within the Nifty and the BSE 100, could actually start to do well. When it goes to mid cap and small cap stocks is something which is, I think, a bit harder to forecast. But there was, as we all know, there was a bit of froth building up there, and so some of the froth coming off is what has happened. So I don't know if many of them are still in value territory.
Neelkanth, whereas the markets are polarized in nature, this is just my personal thought, which is that if I look at the nature of stocks which are at an all-time high, the basket is very well diversified. TCS is a software company, Reliance is a commodity stroke a telecom company, Bajaj Finance is an NBFC, HDFC Bank is a private bank, HUL is an FMCG company. So this is not TMT, or this is not 2004 or 5 where markets were not only polarized, it was the polarization was restricted to a sector. Right now, yes, 8 or 10 mega cap stocks are going higher, but they represent pretty much the entire length and the breadth of the economy.
That is correct. So, the one characteristic of all of these stocks is that over the medium term, they have all added value, with the exception of one or two of the names that you mentioned. And I think and so it is a sign of risk aversion that people are choosing to be in stocks where it's going to be very hard over the medium term to destroy value. And to put it in context, see, when people who allocate money, the fund of funds managers, the family office managers, the pension managers, sovereign wealth funds, when they think about investing in India, they think more or less on the percentage of GDP basis. So, if India is 3% of world GDP, then broadly 3% of our funds should be in India. Now, if you're managing $10 billion, then you have to put $300 million into India. And they will then allocate it to an India fund manager or an Asia fund manager with India exposure, or EM fund manager with India exposure, and therefore a certain quantum of funds must come to India. Now, when this fund manager sits down to invest this money into the Indian market, what they figure out is that, boss, there are metal names, there are petrochemical names, there is a large global automaker, there is a significant export dependence in many of the companies, and therefore when they come down to looking at a pure India plays, they realize that there are very few of them, and then they all sort of crowd into them because they're not as confident of growth elsewhere, and given that there is so much uncertainty, you at least want to be in stocks and companies that you realize will not sort of destroy value over, say, 5 years. So, you take a medium term approach and think that this is the safest place to be. But yeah, I mean, this crowd behavior, this herding behavior actually opens up opportunities, which is that some of these stocks are trading now at record high multiples, and it is debatable, I mean, how much return can be made on them over, say, 2 or 3 years. So they may not fall, but there can be quite a bit of time correction, and therefore our view is that the stocks, some corporate focused lenders, even some of the metal names, are names that now offer very decent value because people are too risk averse to be looking at them, and therefore this is a good time to be buying those stocks.
I'm getting into what you like and what are your preferred sectors, but I want to recap a very interesting headline mail which hit my mailbox a couple of days ago, which is on Rupee. When 70 becomes the new 60. You've shared your thoughts in the past also that a weak rupee is not bad news for India because more than 50% of Nifty earnings, they are actually they are dollar denominated. So walk us through that thought. For most of the investors, weakness in rupee is bad news. That's how we are programmed to think. Rupee ka mandi is bad news for markets. But you are making a differentiated case here.
Exactly. So if you're a dollar investor, then obviously a weak rupee is not very good, right? So in dollar terms, in Nifty returns over the next 10-12 years have been actually quite very bad. But if you are a rupee-based investor, then you have the opportunity of taking advantage, and which is why some of the IT, even some of the pharma names seem to have done better than they would have fundamentally because of the weakness in the rupee. So, as you said, more than half the revenues in the Nifty and the BSE 100 are not really in rupees. So, if you are a metals producer, if you are a petrochemicals company, if you are of course an IT or a pharma company, if you are an auto component exporter, some of the two-wheeler companies have nearly half the revenues coming from exports, construction companies which have significant global exposure. So each of these sees a positive adjustment in the currency. So 5-6% decline in the rupee actually benefits the Nifty EPS by about 4 to 4.5%. And so that in general, and if you see the prior trajectory, so whenever the rupee has fallen by 10% or more in the past decade or so, generally 12 months after that the market is actually in positive territory. I'm not using the fundamental argument that is very tempting to use, that a weaker rupee stimulates exports, causes a lot of import substitution, because our research says that it's that in India's case, India's export and import baskets, the currency sensitivity is actually not very high, at least not in the near term, and therefore the impact on the market is more through the translation impact on earnings. Secondly, when a BOP deficit starts to build up, so we were afraid and we started flagging this in Jan-Feb that there is a lot of capital flight happening, and therefore the balance of payment deficit could be as high as $35 billion, which means that the difference between the current account deficit and the capital inflows that we are seeing is $35 billion. That the projection now is more like 20 billion for us, because things have started to improve at the margin. But the only way to close that is to actually let the rupee fall, and the rupee's weakness was much bigger in January when it didn't seem to be that weak, but in the last 3 months it's actually been among the better performing and actually one of the stronger currencies in the world. It doesn't appear so because we're just looking at the USD INR, but when you look at the rupee in the context of other currencies, it's actually done quite well. So whenever this USD INR adjustment happens, there is a fear among foreign investors. So imagine that you're putting in $10 million trade. Now when the rupee falls 5%, I mean, before even your stock has done anything, you lost 5%. So people hold back on their investment. So once it becomes clear that an adjustment is due, then automatically the FPI investors hold back on their investments. And once they feel that the adjustment is done, then they actually come back and put that money back in. So so that also, I think, helps the markets. And so we have to, I mean, so long as the rupee depreciation is controlled, which it seems to be, and I think there is a stellar job being done there, I think that the markets will hold up, and perhaps once we realize that the rupee is at a position where further depreciation is not necessary, either because oil has come down or because the rupee itself has fallen to a low, then I think a lot of FPI inflows can start happening.
But in general, when you speak to your foreign investors, are they slightly disillusioned? Are they slightly disappointed? Are they slightly irritated with the way how earnings trajectory has moved in India? Because a lot was assumed, a lot was at stake in 2014 after the change of government. And frankly, the earnings trajectory has not only disappointed us, it has in a sense really dampened the way how analysis and how assumptions have gone. I'm asking you, I'm using rather tough words here, but are you getting a sense that if you're an investor, if you took a bet on earnings recovery, you're still hoping? I mean, umeed par duniya tiki hai, magar right now it's only umeed.
So I think at a headline level, there is no way that anyone can disagree with what you just said. There is clearly a single digit kind of EPS growth over 4-5 years for the index is something that is very unexciting, especially for a market which is trading at 17-18 times PE. But within that there are nuances, right? So there are if you look at most of the coincident indicators, and my sense is that they will also start to weaken in the second half of the year, but that's a separate discussion. But as of now, if you see, cement sales are mid to, I mean, now crossed the mid single digit point. Steel demand growth is the best it has been in many years. We are seeing airline traffic grow at 18%, two-wheeler growth is strong, four-wheeler growth is strong. How sustainable they are is a different question, but in many pockets there is actually decent growth. So the reason the headline numbers have been bad, and of course the impatience I can fully appreciate, but for every year there have been a different reason. So in one of the years there was a big loss or big losses among the metal producers, which dragged down earnings. There were inventory losses for the oil producers the year that oil went down. They have been
Neelkanth Mishra